Good morning and good afternoon. Thank you all for joining today. I'm Cassie Schock, COO and Partner for Sanctions and Fraud at D-Risk Partners, and I'm glad to welcome those of you tuning in from across the GCC region. Sanctions is a fast-moving space, and if you're working in compliance, legal, trade finance, or risk, even if your business is not US-based, you've likely felt the ripple effects of sanctions designations. I appreciate everyone's time, so my goal over the next 30 minutes is to give you a high-impact regional snapshot that helps you make smarter decisions faster, especially when the next wave of designations hits. At D-Risk, we specialize in helping institutions navigate geopolitical risk, especially when regulations collide with operations. We're a team of former chief compliance officers, regulators, tech founders, and investigative analysts. We're built to be the people you call when the unexpected happens. When you need to respond to a designation, when you have 72 hours, or when a correspondent bank sends a freeze notice and you need a defensible plan. In the GCC region, that's especially relevant right now. US and EU regulators are zeroing in on financial and logistics corridors through the UAE, Bahrain, and beyond. The sanctions landscape is no longer far away, it's right there. Today's session is designed to be fast-paced, practical, and tailored to what matters most for your institutions. We'll walk through what changed in June with the new Iran-related designations, the growing impact of secondary sanctions, and what an appropriate response looks like when your name isn't on the list, but your counterparty is. And finally, we'll leave you with concrete actions you can take, plus a few tools to get ahead of what's coming. So let's get into the substance, starting with the new regional reality around sanctions enforcement. The first segment is sanctions enforcement targeting the GCC region. Sanctions enforcement isn't just about sanctioned countries, it's about financial exposure. Over the past year, we've seen strategic shifts in how sanctions are enforced. It's not just about direct dealings with countries like Iran or Russia, it's about who's in the supply chain, who's providing services, and who is unintentionally helping facilitate restricted flows. That shift puts GCC-based institutions, especially those in finance, logistics, and commodity trade, squarely in the spotlight. Regulators are no longer asking, did you deal with the sanctioned party directly? They're asking, did you clear the payment? Did your customer insure the vessel? Did you finance the trade that allowed the transaction to process? And if the answer is yes, even indirectly, you may be viewed as an enabler, regardless of intent. In June of 2025, the U.S. Treasury's OFAC designated more than 30 entities linked to Iranian oil exports. Several included companies were based in Dubai. These were not headline-grabbing energy firms. They were general trading companies, logistics brokers, and fronts for crypto wallets, many of them set up in UAE free zones. They were moving billions in oil proceeds through complex payment chains, relying on the assumption that regional scrutiny was lower. But that assumption no longer holds. Here's what this means in practical terms. Don't just screen your customers, screen their ecosystems. Where are their payments going? Who are their suppliers, brokers, freight partners? Focus especially on activity tied to Dubai, Ras Al Khaimah, and Fujairah, all of which continue to be heavily used as re-export and shipping hubs. If a counterparty is moving goods through multiple Gulf ports or suddenly using crypto for settlement, that should be a red flag. Segment 2, the shadow banking problem in the UAE. The GCC, especially the UAE, is increasingly being used as a platform for shadow banking that supports sanctioned activity, particularly Iran's oil and petrochemical trade. Shadow banking networks thrive on plausible deniability. They move through legitimate institutions, banks, brokers, freight companies by blending with normal trade. In many cases, the entities involved are registered in free zones. They have active trade licenses, and they look like any other import-export business. But underneath that surface, they're part of a well-coordinated effort to launder proceeds from sanctioned activities, especially Iranian oil. What changed is this. The US is now explicitly naming and targeting these networks by geography. And the UAE, particularly hubs like Dubai and Fujairah, are featured in designation announcements. That's a shift from 5 years ago when this type of enforcement was more indirect. This redefines the concept of you had reason to know from this looks legitimate on paper to what's hiding underneath. Earlier this month, a UAE-based bank processed what appeared to be a standard payment routed through Hong Kong and tied to a fuel shipment. But buried in the documentation was a link to a newly designated Iranian front company. Within 48 hours, the U.S. correspondent froze their dollar clearing access. This transaction wasn't illegal when it was processed, but the counterparty's designation was retroactive, and the bank had no documented escalation, no response protocol, and no partner communication plan. It took 10 days to get restored. And that only happened after outside support and direct engagement with OFAC. This isn't a one-off risk. These designations are hitting monthly. If you haven't already, you need to implement real-time counterparty change detection, especially for high-volume, recurring trade clients. You should be looking for newly opened accounts tied to freight or energy, entities switching jurisdiction from Hong Kong to UAE, for example, invoices referencing rebranded oil blends. And above all, you should be building relationships with your correspondents before you need them. Silence during a sanctions event can be viewed as guilt. Proactive engagement signals control. For our third segment, we'll cover secondary sanctions. They're real and they're risky. You don't have to be a US company to get caught in the crosshairs. That's the point of secondary sanctions, and they're now being enforced very aggressively. Secondary sanctions are US government's way of saying if you do business with our enemies, you become our problem. They're meant to isolate sanctioned actors by threatening anyone who continues to work with them, even outside US jurisdiction. And they work. Because for most GCC institutions, access to US dollars, correspondent banking, and cross-border clearance is essential. A secondary designation doesn't just create legal issues, it can cut off your operational oxygen. The GCC is now firmly on the radar. Because this region is close proximity to regions where prohibited activity becomes enabled through financing, shipping, trading, or re-exporting, and enforcement agencies are watching those routes. In recent years, we've seen banks in Turkey, Lebanon, and China face direct fallout, not because they broke the US law, but because they enabled transactions tied to sanctioned entities. In early 2024, a Turkish gold dealer was sanctioned for facilitating trade with Iran. Within weeks, the bank lost its US dollar clearing access, even though the bank itself wasn't sanctioned. The risk was association, and that's how fast secondary exposure can spread. And this isn't limited to banks. Freight insurers, crypto platforms, trade brokers, they're all fair game under the executive orders. And in June of 2025, OFAC designation specifically named UAE-based firms in logistics and crypto as facilitators of Iranian oil sales. Your action steps here are don't wait till you see your name in a press release. Start now by mapping your exposure. High-risk jurisdictions like Iran, Syria, Russia. High-risk energy sectors like energy, maritime, crypto, dual-use tech. High-risk functions like trade finance, payments, re-exports, correspondent banking. If you're facilitating any part of the value chain, even indirectly, you're within reach of secondary enforcement. Build a 72-hour response plan that includes notification to your correspondent banks and your local regulator. Pre-script it. Don't improvise. For segment 4, we'll talk a little bit about what local regulators are doing. So sanctions and AML enforcement are no longer driven by Washington or Brussels. GCC regulators, especially in the UAE, are now actively penalizing institutions that miss the mark. There's a narrative that still floats around some compliance teams. We only need to worry if the US comes knocking, but that mindset is now out of date. The Central Bank of the UAE has made it clear local regulators expect institutions to be fully aligned with global sanctions regimes, and they're starting to enforce that expectation in public and material ways. Penalties are increasing, enforcement is more transparent, and the region is now working harder to prove its legitimacy in the global financial system, especially as Gulf institutions attract more cross-border investment and scrutiny. In April of 2025, a local exchange house was fined 2 million AED, approximately 545,000 US dollars, for failure to verify the identity of high-risk clients and for not reporting suspicious activity tied to potential sanctions evasion. In May of 2025, two foreign bank branches operating in the UAE were fined a combined 18.1 million AED, approximately 4.93 US dollars or million US dollars, for weak AML practices and the failure to apply risk-based due diligence to cross-border trade finance. In past years, these events might have stayed quiet, but now they're being made public, with regulators posting fine amounts and citations directly on their websites. And behind the scenes, bank supervisors are escalating faster. Institutions are reporting more site visits, more direct file reviews, and questions specifically about exposure to jurisdictions like Russia and Iran. Action step. If you haven't reviewed your Gulf-facing compliance posture in the past 6 months, now's the time. Start with 3 quick wins. Refresh your sanctions policy to include guidance on UAE enforcement trends. Map your exposure by activity, not just by entity. Which departments interact with dual-use goods? Which have crypto channels? Which are maritime-related transactions? And also, schedule a call with your local regulator liaison. Don't wait for a notice from them. Ensure they understand that you're taking control and you're being proactive. This sends a strong message that your institution is not just compliant, it's forward-leaning. And in this region, that message matters more than ever. So segment 5 is what to watch for right now. The red flags around sanctions exposure are behavior, geography, and patterns. The most dangerous transactions today aren't the obvious ones. They're the ones that look clean on paper but are structurally tied to a designated party through ownership, origin, or intentional obfuscation. And the tactics are evolving. We're seeing more transactions rooted through non-obvious jurisdictions like Malaysia and Singapore or even Armenia, combined with vague documentations and crypto-linked settlement. What's also changed is the level of guidance. U.S. regulators, OFAC, and FinCEN are no longer subtle. Their advisories now include specific phrases, behaviors, and front company tricks to watch for. If you're not using these checklists in your frontline training, you're behind. So let me share some current red flags pulled directly from OFAC's recent enforcement releases and advisories. First, shipping invoices referencing Malaysian blend, light crude, no origin. Second, wire transfers routed through Hong Kong or Singapore, especially to small trading firms or crypto exchanges. Trade partners using freight forwarders based in UAE free zones with minimal online footprint. Sudden client behavior changes, use of new offshore accounts, increased crypto payments, avoidance of US dollar corridors, and counterparties using alias spellings or swapping between Arabic and Latin script names to bypass watchlist screening. These aren't theoretical. These are behaviors found in the last 6 months in real designations. Your action step for this is to pull your last 90 days of trade finance, wire, and crypto transactions. Look for dual-use terms in documentation. For example, power plant components or machine tools. Middleman jurisdictions, UAE to Hong Kong to China. Or clients in acceptable industries using cryptocurrency or structuring trades to avoid US dollars. If you're not running red flag detection on all of that, the next designation wave might hit your books and you won't see it coming until it's public. So the next segment is on sanctions targeting ecosystems. The next enforcement action may not name your client. It might name their shipper or their broker, insurer, or their crypto wallet. If you're financing the chain, you're in the chain. Enforcement agencies have shifted focus. They're no longer just designating companies. They're targeting entire ecosystems of enablement. This means freight forwarders, insurers, commodity traders, and even logistics tech platforms are now being swept into designations. In the GCC, this is especially relevant. Ports like Fujairah, Jebel Ali are major global export hubs. That makes the region strategically important and increasingly scrutinized. OFAC and EU regulators are closely watching the GCC institutions involved in trade finance, shipping, and crypto-linked payments, especially when those transactions touch jurisdictions like Iran and Russia, or the newly sanctioned Chinese entities. In 2025, the EU used new authorities to sanction third country shippers for violating the Russian oil price cap, even though these vessels were owned outside of Russia. And in the US, OFAC designated a UAE-based logistics company that helped transship Chinese-made UAV parts to Iran. The message is clear. If you're facilitating sanctions evasion, even indirectly, you're now fair game. To stay ahead, your program needs to look beyond direct counterparties. Start by mapping critical vendors in your client's supply chains. Service providers like trade platforms or digital brokers who might introduce indirect risk. Red flag corridors, UAE, Turkey, Russia, UAE, Malaysia, Iran, Dubai free zones linked to crypto activity, and upgrade your program design to support real-time escalation, transaction-level risk scoring, ongoing training for trade finance and crypto staff on emerging typologies. If you're only screening names, you're 2 steps behind. The expectation is now you understand the structure of the transaction, not just the identity of the participant. Segment 7, sanctions exposure across the supply chain. The main point here is the most dangerous sanctions risk may not come from your direct customer, but from their shipping partner, trade platform, or insurance broker. We used to think of sanctions risk as a linear transaction, buyer, seller, maybe a bank. Now it's a web. A shipment may have to move through 5 jurisdictions. It may be insured in a 6th, financed in a 7th, and partially paid in crypto. Regulators are watching the entire flow, not just the names at the endpoints. So if your program is only screening your client list, you're missing most of the risk. The US, EU, and UK have all issued guidance and enforcement actions in the last year that made this shift clear, designating vessels, freight forwarders, and shipping intermediaries, targeting third country enablers, especially in Asia and the Gulf, issuing advisories around maritime deception, crypto obfuscation, and layered logistics. And the Gulf region, because of its role in global re-export shipping and trade finance, is now squarely in the spotlight. UAE-based logistics firms in Jebel Ali have been designated for acting as a front company to transship Chinese-made UAV parts to Iran. The firm never appeared on the transaction paperwork, but when U.S. investigators mapped the routing, it was clear the company enabled evasion through the free zone warehousing and re-export. Several tankers flagged in Dubai and operated through Turkey were cited by OFAC and the EU for violating Russian oil price cap. Even though the ownership was layered through holding companies, the supply chain was penetrated, and the insurers and trade financiers tied to the deal were flagged for heightened review. A Bahrain-based fintech platform was recently pressured to improve sanctions controls after Russian origin payments were routed through small denomination crypto purchases that touched GCC wallets. These aren't hypotheticals, they're part of a clear regulatory trend. If you touch the transaction, you're in scope, no matter how indirectly. What does this mean for compliance leaders in the region? You're expected to know your client's vendors, screen service providers and brokers, map jurisdictions and transaction points. Understand how shipping, trade, and digital payments intersect. Actionable framework here is to build a sanctions-ready program. You should have multi-layer screening, not just customers. You should know their shippers, brokers, and digital partners. Use enhanced due diligence on parties operating in Dubai-free zones, Turkish logistics corridors, or crypto-linked payment chains. Transaction-level risk scoring. Flag deals involving dual-use goods, non-transparent routing, or shell entities. Build logic for trade corridors. UAE, Armenia, Russia should score differently than UAE, Germany, Canada. Cross-functional escalation. Designate roles across compliance, trade ops, legal, and tech. Create playbooks for when a deal arises and red flags are raised due to port, carrier, or jurisdiction. Real-time escalation readiness. Don't wait for external flags. Empower teams to pause deals based on pattern recognition. Maintain relationships with correspondent banks, your regulators, and external counsel to support quick consultation. And sector-specific playbooks. Energy, shipping, crypto, defense-related exports. Each needs its own red flag matrix. Build tailored procedures instead of applying generic compliance rules to all business lines. So at D-Risk, we help clients not just build policies, but operationalize this kind of risk thinking. This means training teams to recognize suspicious routing, building dashboards to track exposure across jurisdictions, and designing escalation models that work at the speed of business. You don't need to screen harder, you need to screen smarter. The risk is in the structure. And if you can see the structure, then you can stop the problem before it becomes a headline. Thank you for your time. We appreciate any reach out, and if there's anything we can do to help, please either inquire at our website or you can contact me directly at Cassie@d-riskpartners.com. Thank you.